Friday, March 6, 2020, Maneco 64, home of alternative economics and contrarian views. Today, I want to look at where the price of gold could go in US dollars, of course, in the current reset that we're having. Reset, of course, is another word for a correction, and I think we have been having a correction since the year 2000. And you will see what I mean when I go over my analysis. I will also reference a really good interview I did on January 31st this year with Dan Oliver of Mermican Capital LLC. I'm using some of his research to do this analysis. In that interview, Dan Oliver touched upon what I'm going to talk about today. Where the price of gold could go in relationship to the Fed's total liabilities. So before I go into the subject, let's quickly look at the markets this morning. It's almost 9 a.m. London. I am a little later today, but I was doing a little bit of preparation for this video. So yesterday, of course, was another interesting day. The Dow dropped almost 1,000 points, 969 points, 3.58%. So right now we've got spot gold at $16.77. That's up $5. The high has been $16.81, the low $16.67. Silver is at $17.36, down 5. The high's been $17.54. Silver is frustrating at the moment, but I actually think it's like a coiled spring, and it will eventually explode higher. Difficult to say when, of course. What about the stock market this morning? Well, the Dow futures down 271 right now, or 1%. S&P 500 down 1.2%. Below 3,000 at 29.87. NASDAQ 100 future down 110 or 1.25%. Currencies continue to strengthen here this morning versus the dollar. Yesterday we saw the dollar index, I think, drop just below 97. Right now sterling is up 0.2% at 129.72. The euro is up a third at 112.72, and the dollar is down a third versus the yen at 105.76. So not good going for the dollar right now. Versus the yuan, the dollar is pretty much unchanged at 693.55. WTI crude's down 1.3% at 45.37. Bond market, the 10-year yield actually is shocking this morning. It's down 15 basis points. It's at 77 basis points. So just recently we broke 1%. I'm quite shocked at this move actually in the 10-year yield. The 30-year is down 20 basis points at 136. So quite amazing. This is not good. I didn't expect actually for the yields to be down as much as they are. So let's go and look at the reset of the system. And why gold? Well, because the Federal Reserve, they hold gold certificates worth about 261 million ounces of gold. They value it, of course, at $42.22. That's the official price for the U.S. Treasury under U.S. law. So they've got just over $11 billion worth of gold, valued, of course, at 42.2. Where the price of gold could go in the reset, and I would say it could go to different levels, but we're going to look at where it did go in the past. In 1980, the Fed's gold certificates covered its liabilities 135% when gold reached $887.50, according to Mermican Capital. Well, that's Dan Oliver, the guy I had the interview with on the 31st of January. And he did the calculations. In January of 1980, when gold reached that high, the balance sheet of the Fed, the liabilities, total liabilities of the Fed were covered 135%, which is silly. Usually, even during a gold standard, I think the UK gold standard in the 19th century, the banking system in the UK used to keep a third cover of gold for the liabilities of the banking system. So 135% was an exaggeration. So this is what Dan Oliver says. The panic in 1980, for example, sent gold to a price that caused Federal Reserve liabilities to be gold backed by an absurd 135%. To achieve the similar figure today would require gold to trade over 20,000 per ounce. And that's assuming that the Fed's balance sheet or the Fed's liabilities, remain the same. The liabilities increase, of course, as the Federal Reserve increases its assets, as it does more QE. So let's look at the Fed's data. So the Fed's gold certificate holding in millions of dollars as of March 4th, 2020. So there we go, 11,037 millions of gold, which is 11,037,000,000 they hold in terms of gold. So if you divide the dollar amount by the official US Treasury price, there you get just over 261 million ounces of gold, troy ounces of gold. If we look at the Fed's total liabilities as of March 4th, 2020, 4,202,949,000,000. So gold price, if Fed's total liabilities to be 100% backed by its gold certificate holdings, so you see the calculation here, you would get $16,077. If we had the extreme valuation, or if we had the extreme gold backing of 1980, the price would be at $21,703 per troy ounce. Of course, that total liability could change, and probably will, with what's going on. It's probably going to go even higher. So that number could be even higher. Both numbers could be even higher. So let's look at the Dow Gold Ratio right now. Just a few minutes ago, before I started the video, I calculated the ratio. It's around 1540 right now, the Dow Gold Ratio. This is the Dow Gold Ratio in the last 100 years. You can see why now I think the reset has been ongoing since the year 2000, because that's when you needed the most gold to buy the Dow. The Dow represents financial or paper assets. Gold represents real money, tangible goods, tangible assets. So I think we've been having a reset since then. Yes, it has rebounded since around 2011, but I think the trend is still lower. This is just a correction. So let's look at the previous resets. Well, the major reset in the early part of the 1900s was after the crash of 29 during the Great Depression, when Roosevelt came in and confiscated gold in 1933. The Dow Gold Ratio reached 194 in February of 1933. And then the reset in 1980, the Dow Gold Ratio reached 129. So that was when the Fed's total liabilities were 135% gold backed by its gold certificate holdings. So right now, if the Fed backed its total liabilities by its gold certificates by 100%, we would have a price of just above $16,000. Historically, as I said, you could see gold backing at a third or 50%. So we could argue 8,000 could be a level, or even 10,000. So it's really going to depend on how the market reacts, on how deep the crisis is, I think. Of course, if we went to 135%, that would be very brief, I would say, and it would be right now around 21,700. So there you go. Shocking move, though, in the Treasury yields, I would say. The fact that the 10-year yield has moved so much overnight. So there you go. This gives you an idea of where gold could go. So hold on to your precious metals. Yes, it's going to be very volatile and choppy out there, in my opinion. But at least you have an idea of where the price could go in terms of the Dow Gold Ratio and the Fed's liabilities and the Fed's gold holdings. What we can say, though, is that the liabilities are going to continue growing. The Fed's gold holdings, certificate holdings, they have been unchanged for decades, so that's going to stay the same. So the price is going to move higher. The theoretical backing price of gold will move higher as the liabilities increase, as the Fed does more QE and increases its assets, the liabilities will increase, of course. If you enjoyed this video, please hit the like button. Please share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Facebook, BitChute, Steemit, and DTube. And I also have now a blog, maneco64.net. I wish you all a great day. Take care. Bye.